And in the early days,
Right.
even the publicly traded REITs did that, to the point that for years we couldn't find a REIT that had an average annual return of over 8% in the public traded side. Nowadays, you can find them that beat the S&P, that are north of 12%. Now, not all of them do, but there are some good ones that are actually beating the S&P and would probably be a pretty decent investment for some people really interested in that. The private ones just leave you open to, you just got a lot less transparency, a lot less insight, and a lot less liquidity. It's very difficult to get out of them once you're in them.
Many Americans find it challenging to afford real estate due to limited cash. However, there's an alternative route available through Wall Street, known as Real Estate Investment Trusts, or REITs. An REIT is like a club where investors pool their money to invest in real estate. It's like buying a piece of big real estate portfolio without purchasing a house. REITs are unique because they're publicly traded on the stock exchange, meaning that you can buy and sell them like stocks. They extend beyond housing, encompassing various types of properties. In the United States, these REITs manage an impressive $4.5 trillion worth of real estate. This is why many wealthy individuals include them in their investment portfolios. REITs offer tax advantages, diversification, and regular income yield, plus can protect against inflation. In recent years, the REITs safeguarding individuals' interests have quietly orchestrated significant deals across the nation, creating a big change in how money moves around. The power of these protective rights reaches wide and far. In the United States alone, about 150 million people hold real estate investment trusts within their retirement accounts, mutual funds, and investment portfolios, often without even realizing it. This means almost everyone is closely connected to these deals, even if they don't know it. This newfound influence given to big financial firms on Wall Street gives them a big role in deciding how construction projects and cities develop. As they arrange loans and money for various projects, REITs use their power to ask for specific things, like certain excellent features and insurance coverage. These requests affect places that weren't thought of as very valuable for real estate before. The rapid expansion of real estate investment trusts has raised significant concerns among experts due to its potential far-reaching impact on tenants and the broader real estate landscape. As developers construct properties and subsequently sell them to REITs controlled by powerful Wall Street entities, this dynamic places considerable pressure on tenants. The necessity for quarterly financial reports and the relentless pursuit of profit margins can lead to properties being managed solely for financial gain, often at the expense of tenant well-being. Consequently, rental properties within REIT portfolios might be subjected to escalating costs over time, making affordable housing an increasingly elusive dream for many. The emergence of REITs as dominant players has brought about transformative changes within the U.S. real estate industry, causing a significant shift in the landscape of investment opportunities. Traditionally, the pathway for Americans to partake in real estate investment was through home ownership. However, the advent of REITs presents a striking departure from this conventional model. Instead of investing in a single property or a small collection thereof, investors now have a chance to become stakeholders in thousands of properties, granting them broader exposure to the multifaceted real estate market.
Even though the interest rates have gone up, there still is a dramatic inventory shortage in real estate in almost every city. In order for prices of anything to come down, supply-demand curves have to shift, meaning that the supply has to be much higher than the demand. But when there is the opposite, a shortage versus a glut in the market, when there's a shortage, prices go up. So if you want to cause the prices on something to go up, make it scarce.
Though individuals may already possess personal residences, such properties serve a distinct role within an investment portfolio when contrasted with income-generating investment properties. REITs allow individuals to access a diverse range of real estate assets that might otherwise remain out of reach. However, skillfully navigating this complex arena necessitates a nuanced strategy, as well as a thorough understanding of pertinent legislation and potential tax implications. Decisions involving REIT investments often come with a time horizon of 5 to 10 years, demanding thoughtful deliberation and thorough research. Over the years, the REIT landscape has undergone a remarkable transformation. In its formative years during the 1960s, 70s, and 80s, REIT options were confined to a handful of categories, such as office spaces, hotels, industrial properties, and multifamily housing. However, as the market matured and evolved, the diversity of REIT types experienced exponential growth. In the present day, a plethora of specialized categories exist, encompassing an extensive spectrum of real estate assets. The burgeoning array of REIT offerings manifests in the expansion from traditional sectors to innovative, technology-driven domains. For instance, data centers, which house vital server infrastructure, have gained immense prominence with the ascent of cloud computing and artificial intelligence, and they now occupy a prominent position in the REIT landscape. Noteworthy players like Digital Realty Trust have established themselves as leading REITs within the data center sector. The surging demand for these services suggests that this segment is poised for substantial expansion and growth in the foreseeable future. Over the past 10 years, the real estate investment arena has undergone remarkable transformations. Notably, two sectors have stood out as significant players: self-storage and industrial real estate investment trusts, REITs. These sectors have yielded substantial returns, while others like timber, retail, and office funds have struggled with underperformance, especially when measured against the robust performance of residential housing investments. Among the successful REITs, a clear focus has been on apartment complexes and specialized districts. This strategic direction not only ensures financial gains, but also fosters the creation of close-knit communities. Profits here are intertwined with community development, as these REITs actively invest in innovative assets that contribute to local growth and enhancement. Looking at the United States real estate market, it becomes apparent that residential housing has witnessed a remarkable upswing, experiencing an impressive 18% in prices over the past decade, accounting for inflation. This surge can largely be attributed to the consistent scarcity of the housing supply, a key driver behind the continuous price rise.
Buy and hold strategy on real estate, while it generates cash flow, it should outperform stocks, but it has more hassle. It's an imperfect market. Each item is unique. Real estate creates three types of return: increase in value and rental income. And three is you get to depreciate it, so you actually get a tax break. Real estate gives you a lot more opportunity to get a bargain. In other words, on stocks, you got two possible places of return. One is the increase in value. Two is possible dividend payout.
A significant turning point emerged in 2018 when the real estate market underwent a substantial transformation, marked by the availability of numerous properties previously owned by individuals. Seizing this opportune moment, REITs recognized an untapped market demand and took steps to fulfill it. Interestingly, they embarked on this at a lower price point, leveraging their expertise in rental property management to cater to this emerging demand effectively. In the domain of residential single-family rental REITs, two prominent names have risen to prominence: American Homes for Rent and Innovation Homes. These entities, historically engaged in purchasing and renting homes, have now expanded their roles. They are actively involved in constructing purpose-built homes for the rental market, a dynamic shift that has led to a surge in single-family rental properties. This transformation is significantly fueled by the changing financial landscape, characterized by the rising interest rates that have made traditional home ownership financially unattainable for many. However, the desire for a single-family home within a community with amenities like a backyard and access to quality schools remains steadfast. Consequently, an increasing number of individuals opt for single-family rental homes as a viable alternative, thus creating a burgeoning segment within the rental market. As we peer into the future, there is a shared sense of excitement about the ongoing growth as a specific pattern. This trend, we believe, will maintain its upward path for the next 10 years. The reason for this prediction lies in the alterations happening in the economy, combined with changing tastes. These factors are expected to establish the importance of single-family rental REITs. These initials, of course, stand for Real Estate Investment Trusts, and they focus on renting out individual houses, not large apartment complexes. This particular area of housing is set to flourish, becoming an essential part of the rental market. The reason is simple. It offers a housing choice that fits well with the varied needs and dreams of a diverse and ever-changing population looking for places to live.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay. Whereas if you get an inflationary expansion in replacement capital without having to replace yourself.
Real estate investment trusts have become key players in reshaping both urban and suburban landscapes in cities. Their initiatives frequently encompass mixed-use developments, strategically sitting amenities like grocery stores near their properties. This approach stems from a concerted effort to scrutinize market demand, enabling them to prosper even in less competitive submarkets. Intriguingly, this tactic isn't universally applicable. What proved successful in Orlando's neighborhoods might necessitate modifications when implemented in Tulsa, Oklahoma. The main problem of the crisis is in the lower parts of the market. Making fancy apartments for rent at $2,500 for a small apartment doesn't solve the issues of being able to afford or reach housing. The big difference between the number of homes available and the number of people who want them shows that we need affordable housing solutions immediately. Apart from buildings, REITs also include investing in trusts. Setting up these trusts in an intelligent way gives good tax benefits. Trusts that invest in facilities usually pay out a lot of money they make, which matches their primary goal of providing regular income to the people who own shares. As ordered by Congress back in the 1960s, REITs stick to important rules. These rules say that they must focus on real estate investments and give a big part of their profits to shareholders. Right now, people who invest in REITs get a 5.3% dividend yield, which is a nice amount of money. But the real reason they're so good becomes clear when you think about how much money you actually get after taxes. This really good financial perk makes REITs even more appealing to invest in. Real estate is a smart way to invest because it's suitable for taxes. This is primarily because of something called depreciation deduction. This helps investors balance out the money they make and the money they spend on their properties, so they don't have to pay a lot of taxes. Especially when interest rates are low, REITs that produce a lot of dividends have been getting even more popular. This happened because of businesses that borrowed a lot of money and led to cycles of housing prices going up, even when interest rates stayed low all the time. The appeal of high-dividend REIT funds offered a tantalizing option for investors in pursuit of substantial returns, which were hard to come by due to prevailing inflation. However, some Democrats in Washington hold the view that the rise of Wall Street REITs has granted disproportionate advantages within the contemporary real estate landscape. This shift is argued to create obstacles for first-time homebuyers by pitting them against dominant Wall Street corporations. Moreover, it bears implications for local communities as corporate entities replace local landlords. Consequently, the traditional landlord-tenant relationship transforms, with rent payments directed towards Wall Street rather than local property owners. While these concerns prompt calls for change, it's essential to recognize that the growth of commercial real estate has been nurtured, to some extent by specific tax codes and investment strategies dating back to the 1980s. The presence of Wall Street REITs has played a crucial role in gauging the financial pulse of the nation. Industry experts assert that REITs are gaining prominence in commercial real estate, positioning themselves as the third largest asset class in the United States. With a significant capital influx of around $300 billion, REITs are expected to capture a substantial market share. Looking ahead, it seems to be a matter of when, rather than if, activity will experience rapid escalation. Notably, REITs play a pivotal role in providing liquidity to the real estate market. For instance, KKR's acquisition of a sizable complex near Philadelphia from the Post Brothers in 2022 exemplifies the importance of evaluating multifamily investments based on property appeal and market allure for potential occupants. Philadelphia serves as an illustrative example of a market with a promising long-term prospect.
Inventory shortage in real estate in almost every city.
Within the world of real estate deals, the importance of assumable loans becomes clear. Being able to transfer loans to new property owners has a big impact on whether a deal can happen, especially if interest rates go up a lot. If loans can be transferred, it affects how much properties are priced and how affordable they are because higher costs impact the market. As things change, a noticeable group of new homes coming into the U.S. market might be ones that people bought when mortgage rates were really low during the pandemic. People in charge in Washington are working to bring balance back to a market that's being more and more controlled by big real estate companies on Wall Street. Even though owning a home is still seen as a way to build wealth in the U.S., things are changing with the kinds of people who are buying homes, especially among Gen Z. This is making people rethink the old way of owning a home. Even as real estate developers aim to maximize profits, a critical shift towards equitable growth becomes paramount. This entails aligning profit-seeking goals with considerations of how their activities contribute to the overall well-being of communities and individuals, ensuring a balanced approach to development that benefits all the stakeholders. In essence, the evolving landscape of real estate, influenced by taxation, market trends, and shifted demographics, presents both opportunities and challenges that shape the future trajectory of this essential asset class.